So good afternoon, everyone. I'm Beatrice Risser, the Director General of ecoDa, and I would like to welcome all of you to this webinar on corporate governance and corporate reporting. This webinar is organized in partnership with ecoDa and Mazars Forvis. This webinar echoes an external study commissioned by DG FISMA to assess the effectiveness of corporate governance frameworks in relation to corporate reporting quality. This webinar is also in line with a previous consultation on corporate reporting organized by the Commission in 2022. So basically, effective governance practices directly influence the quality and the accuracy of corporate reporting, which is crucial for stakeholders' trust and informed decision-making. For this webinar, I have a pleasure to be joined by 3 expert speakers. So we have with us today David Herbinet, Global Head of Audit at Forvis Mazars with over 25 years of experience. David specialized in audit quality and competition, working with major companies across various sectors. He also leads global audit policy at Accountancy Europe. Next, we have with us Anne-Hélène Monselatto. Anne-Hélène is from ecoDa. She's an independent director with deep experience in corporate governance. She shares the audit committee at Genfit, and she has held leadership roles at Euronaf. Anne-Hélène is an expert, and you will hear that she's an expert in audit, risk, and ESG matters. Finally, we have with us David. Good afternoon, David. So David Risser, Managing Director at Sodali & Co. Sodali & Co. is the new name, the new brand of Morrow Sodali. And David advised boards around the world on governance, sustainability, and risk management, with a focus on building effective, resilient corporate structures. We will start with a discussion with our panelists, and then we will open the floor to you for a Q&A session. But we aim to wrap up at 5:30. Please note that we will be using the chat function for questions as usual. And this session is being recorded, and the recording will be available afterwards for those who may have missed part of it or wish to receive or to review the content. But without further ado, we should kick things off, and I will turn first to David. David, given the current patchwork of practices across the EU and the new requirements under the CSRD, do you think that there is still a need for further harmonization of the EU corporate governance framework? And my second question would be, can you help us to learn a bit more about the audit debate in the UK? So please, David, the floor is yours.
Thank you very much, Beatrice, for this very kind introduction. And I'm absolutely delighted to join this panel today and to continue the good collaboration that we've had between Forvis Mazars and ecoDa over the years on this important topic of corporate governance. And in particular, to apply this today in the context of corporate reporting. I thought, I will answer your question, Beatrice, definitely, but I thought it could be helpful for the discussion today on the panel to start by setting the scene for this question. I'm not in relation to that, I'm not intending to say anything particularly deep or revolutionary, but I think perhaps providing a few key elements of context will facilitate the discussion that will follow on the panel with Hélène and David. So corporate governance is traditionally defined as a system by which companies are directed and controlled, and as a set of relationships between the management of the company, the board, the shareholders, and now an increasing number of other stakeholders. And of course, the primary goal of corporate reporting is to convey the value of a company that it creates and the impact the company has on the people, the environment, and wider society. So for this purpose, I think we'll take corporate reporting as extending beyond just the annual report and the financial statements, but across all of the communication on financial and non-financial information to stakeholders. So of course, you know, we would say that good governance is absolutely critical for value creation and value protection for multiple stakeholders. The European Union in particular is driving good governance and good reporting in tandem, and that is absolutely critical to the European Union priorities to build a prosperous and competitive Europe, notably in relation to developing a successful capital markets union and succeeding in the green and digital transitions. So lots of boxes that are being ticked through good governance and good reporting. You mentioned very briefly sustainability. Of course, you know, governance is also key to the Green Deal and seen by the European Commission as an important tool for implementing the sustainable targets, and notably in the context of, you know, CSRD, CS3D, and the implementation of the SRS. So what I want to do in the next 5 minutes is really try and cover quickly 4 topics. The first one is why the focus on governance and reporting. 2 is what is a EU corporate governance framework today? 3, are we dealing with an homogeneous framework among member states? And I'll start to approach the question you've asked. And 4, what are the key challenges to companies today for good reporting? I'll be very quick on each of these topics, but I thought I should take you through that. So first of all, why focus on governance and reporting? You know, it's been a key focus of the European Commission over the years, and this will continue because good governance and good reporting improve trust and transparency. It enhances the quality of sustainable reports, which you know, are becoming very critical now. There is also an underlying objective of reducing the administrative burden. So good governance and good reporting have got that efficiency objective as well embedded within that. It ensures financial stability and investor protection and ensure that there is appropriate capital allocation across the EU. And again, very, very key on this capital allocation question when it touches on sustainability. And last but not least, it looks at corporate governance issues on the back of various scandals, frauds, and again, with sustainability, increasing concerns in relation to greenwashing. So that was question 1. Question 2 was, what is the EU corporate governance framework today? And, you know, I think it's important to remind ourselves of some of the bases of corporate governance across the EU member states. Since 2003, the European Commission has been very active in developing various action plans, putting in place recommendations, directives in relation to governance. And importantly, since 2006, all listed companies are required to publish a corporate governance statement in their annual report. But today, corporate governance is quite a complex framework in the EU. It's a combination of legislation, soft law, best practice, and you know, one of the key concepts that's been adopted, and I believe is an important one, is the concept of comply or explain. So it's not a rule-based approach; it's a comply or explain basis, and I think that's important. So, what are the key elements today of the governance framework? First of all, you've got legislation and directives, so that's the harder part of it. Then you've got a number of corporate governance codes, which are mostly at a national level. So we move into soft law, comply or explain. And then you've got various additional layers in relation to specific regulations across the EU, but also at local levels on corporate reporting and auditing. You've got specific requirements for public interest entities, and also additional ones even even for financial services entities. And within all of that, quite complex framework, you've got various requirements relating to internal controls and the effectiveness of internal controls. And I'm sure we will come on to that with Helen in a couple of minutes. The third question I'm trying to address is, are we dealing with an homogeneous framework among member states? And the answer is clearly and unequivocally no. And importantly, there are very good reasons why we have this non-homogeneous framework among member states, despite various attempts to create more consistency. It's just because the legal framework in most countries differs quite a bit. If you look at the board structure and composition, it can be very different across Europe. You've got two-tier board system in some countries and single-tier board system in others. You've got very different shareholder rights with some countries promoting more the controlling shareholders, others giving more rights to minority shareholders. You've got different levels of stakeholder engagements, and many countries in Europe, but not all, providing a seat to employee representation in the governance framework. You've got very different requirements around transparency and disclosure at a local level, and also very different approaches to long-term value creation. So very big patchwork of frameworks, of environments, for good reasons. And I would like to draw your attention to a very interesting survey by Accountancy Europe. They looked at 17 countries in Europe and the corporate governance arrangements there. And I think it provides a really good and interesting perspective on this. My third question before handing over to the other panelists is, what are the challenges for companies today for good reporting? And I think there are 5 key challenges. One challenge is around understanding just exactly that complexity of frameworks, laws, regulations, best practices. Companies are dealing with a very complex environment, and it's not easy. Then you've got the question of materiality. What information is material? Companies should focus on communicating material information, but there are different views on what that means. And now with the concept of double materiality through the ESRS, that adds another layer of complexity through the definition of materiality. You've got challenges around data quality and consistency to report meaningfully. You've got challenges around internal controls and processes that are required to ensure reliability of this information. And then you've got, I mentioned it at the very beginning, this reporting burden that the EU is trying to alleviate, and that is sometimes contradictory with the increasing demands on reporting. So I thought that taking you through that could be useful, and I hope it is useful. So let me just close with a kind of a response to your question, and also an opening statement for the rest of the panel discussion. There is, in my view, a very clear need to harmonize practices and implement good practices across the EU. But in my view, this is more to do with implementing already what we have, rather than rushing to implement new things. I think, I mentioned complexity. I think there is a lot in the existing frameworks that companies can work with, but we really need to improve how all of this is being implemented. So just, my opening statement. And on this note, I'm very pleased to hand over to Anne-Hélène.
Yes, thank you, David, and thanks for this overview. I think you have already touched upon a couple of important elements. So yes, indeed, let's dive deeper with Anne-Hélène. Anne-Hélène, you have a good understanding of audit committees, both in the EU and in the US. So how do you think the audit reform has impacted the quality of corporate reporting and the oversight by boards and audit committees? And is there still room to improve internal controls and the internal audit function? Anne-Hélène, please.
Yes, thank you, Beatrice. What we can say regarding the impact of the EU audit reform, so it's a reform dating back for 10 years now, so it's 10 years in, is that it has clearly delineated the missions of the audit committee. So it has put a lot more emphasis on internal control over financial reporting, reducing the scope, on external audit quality beyond results and outcome of the audit. So it's external audit quality and conditions of the audit, threats to independence, and also it has highlighted the need to properly report to the board. Remember, we have to inform, the audit committee has to inform the board of the outcome of the statutory audit, but also it has to explain how the statutory audit has contributed to the integrity of the financial reporting and what the role of the audit committee was in the process. Also, to be noted, we have now the audit regulators, creation of the audit regulators and assessment by the audit regulators of how audit committee works. So this has created an environment that I totally concur with David. We have a lot on the table right now. The second topic I'd like to discuss is regarding room for improvement, and I agree it's in terms of a greater homogeneity across Europe in terms of practices. Practically, what is required, what is considered good practice under each of these missions from the audit committee. And if we discuss the point, and it's a point on which I'm very keen to discuss, as David pointed, regarding internal control over financial reporting and tool over non-financial reporting, it's because investors' expectations around internal control over financial reporting are very different now, 20 years, more than 20 years after Sarbanes-Oxley in the US. The consequences of Sarbanes-Oxley was really to put an internal control framework, which is ecoDa, which was a confidential, academic, untested system to the forefront, where now it's applied in practice by management, and the whole process is now routinely subject to audit. And when I mean audit, is reasonable assurance. So we have material weaknesses. Those material weaknesses, when they are spotted by management and concurred with by the auditors, they have to be disclosed in annual reports. And the resulting consequence of that is that internal control is taken very seriously by management, by the CFOs, and by the board now when you are in a company listed in the US. So basically, in terms of homogeneity of practices, if you are in a company dual listed in Europe and in the US, you apply a ecoDa type system of internal control over financial reporting assessment. If you just a company listed in the EU, you don't apply that framework. So it's a totally different mindset. And as you know, just touching briefly on that, the benefit of a systematic approach of internal control is that it goes way beyond internal control activities. It requires an analysis by processes, a systematic approach, identification, documentation, and annual testing of key internal controls, a deep look at internal control environment, so looking at policies, procedures, but also tone at the top, culture built within the company, risk assessment, monitoring functions. So it looks at the very different perspective on how the whole process is working. And generally, it leads to automation, which is a key point in securing the reliability of data flows. What it has not, so improving the homogeneity of practices in the EU in terms of what's behind that requirement of monitoring the effectiveness of the company's internal quality controls and risk management, it would really be key in the improvement of the overall quality. What the EU audit reform has stopped short of is requiring an internal audit function. It's still something which is not mandatory. And to be honest, past a certain thresholds, internal audit is a must. And it's really part of the monitoring layer of a robust internal control framework. But for some companies, without having, you know, a mandatory framework like we have under Sarbanes-Oxley, you're not required to have an internal audit to be considered to operate efficiently. And from the standpoint of the external investors, when they think internal control, they think now about a US type system of internal control, which is not exactly what we have currently. So I agree again with David. We have a lot of things on the table. It's written in the directive, it's transposed in the law, but there are very different, wide disparities, very different approaches into how those are applied in practice. And we would very much benefit from having, a more robust interpretation as to what should be expected, at least regarding internal control.
Thank you, Anne-Hélène, for your insights. I think we can take the time to have a conversation, and I would like to turn to our two Davids. Do you have any thoughts or reaction to what was just shared by Anne-Hélène?
David R. I can to distinguish.
Yeah, should give you
too many
number.
Davids. There is one thing where I would like very much echo what Hélène mentioned. That relates to how in a sense the board members that are entrusted by the shareholders to ensure the long-term success of the firm are well supported in their work. And when it comes to internal controls, they kind of lack of time and the lack of resources often. We'll come to the discussion about the audit committee and the way it organizes its work, especially in the light of all the different tasks that the audit committee is now to be entrusted, from financial disclosures, effectiveness of internal controls, over financial reporting, over non-financial reporting, and over internal controls, full stop. There, in my experience of working with boards for the last 20 years and more, you really see that the best relay for board members and audit committees is specific functions like internal audit, for instance. And in many organizations, even in large ones, internal audits are a bit lonely in the organizations. Even though the institutes of internal auditors are doing a lot of pedagogy, education, and equipping the members to promote the function, but often not enough people as well are there to support their work. So a bit understaffed often, and the time that internal auditors spend with audit committee members is very variable, and it's very actually much up to the chair of the audit committee that is willing to dedicate regular time and attention to one-on-one discussion with the chief audit executive. And that goes into practices that do not transpire through disclosures. And these are aspects that are hidden, but I think are core to ensuring some of the strong controls.
The other David Herbinet, do you have any thoughts on that?
Yeah, thank you. I think definitely I agree with Anne-Hélène that the US experience is very instructive for Europe, and there is much to learn from it. There are certainly some good features that companies could take inspiration from, and definitely. I think on the other side, the US experience shows some rigidity and kind of it's at the other extreme in a way to the comply or explain approach that is encouraged by the EU. And what we've seen is that while clearly it seems to have had some positive impacts in the US. I think we've seen as well that when every time that the SEC was allowing certain companies to not be in that framework, companies usually made the most of it, and were exiting that relatively rigid framework. So, you know, I think we need to keep to the spirit of the EU framework. You know, comply or explain. Understanding the diversity of legal environments and cultures and approaches across the different member states, but take some of the, you know, best aspects of what Anne-Hélène has described. And I think, you know, so the way that a company can go about formalizing the processes and the controls and so forth, I think that's, you know, bring a little bit more formality in the way companies go about it, I think can have definitely some positive impacts.
David, you just mentioned that the internal audit function feels a bit lonely in the company. Can I ask you, to you and the others, the following questions? Do you have a feeling that audit committee members challenge enough the internal audit?
I mean, here it's more than purely challenging. It's a trusted relationship that needs to be built between the two, so it's really taking the time to understand a number of the findings that can be done by internal audit functions. It's as well the limitation, the number of audits that can be done by a firm, especially if the firm is of middle size. I mean, that is as well a number of limitations behind that. So the close relationship is an important one. Close relationship with both the board or the audit committee, and as well, frankly, with the management. So it requires skill and talent from the chief audit executives, and many are in my experience in doing that. But that's one aspect here, and I think we'll come even to that later. It's the massive asymmetry of information that exists between the board members and the rest of the organization, that is difficult to properly digest on one hand, and ensure that the board members are able to spend sufficient time on addressing them. I'll stop here to leave the room, but more than that kind of challenge is that working relationship that is very much up to people and organizations.
Anne-Hélène, any reaction on that?
I think you're right on spot, Beatrice. When we discuss with the internal audit officers, they will tell you often that it's very difficult to have a dialogue with governance and to have a lot of interest from governance regarding what they are doing and the added value that they have to the organization. So it's not true for all companies, but it's a regular complaint that we hear in terms of how internal audit can provide more value to the board, and it's difficult for them. The point is that internal audit, so we should not make the confusion between internal audit and what an internal control department should do. Internal control department should be responsible for testing the internal control, be it over financial reporting or internal control at large. And the internal audit will really be that third line, which will take the higher level view on how a certain number of processes are working out within the company. So if we take, for example, internal control, they could very much tackle such questions as is the internal control structure becoming toxic because of too much granularity? You know, answering to David regarding drawbacks in a badly carried out Sarbanes-Oxley project, for example. Is it really based on a risk-based approach, you know, and not something too detailed? Are we lost in a compliance rabbit hole, for example? In certain companies, they can be so deep into too many controls that it's becoming toxic, as I said. Is there tolerance to the normalization of deviance? How should companies adapt their internal control structure to an age of remote working, quiet quitting? So, you know, internal control, it's not something which is fixed. It's not rigid. The framework, and that was the very interesting thing that COSO brought on the table, is that it's something which is fairly adaptable to various sizes of companies, environments, situations, but still it's a very, very dynamic process. And here, internal audit can have a view, take the higher level view to make sure that we are still with something which is moving, dynamic, and providing value. So there is a real added value of internal audit per se, and I must admit that a certain number of boards still miss the point in terms of the depth of the discussion they should have with their internal audit chief officer.
Yes, definitely. I think you're raising a good point, and more education is needed on that, not only for boards, I think, but also for regulators. But let's move to our next topic. I would like to hear from David Risser this time. David, does it make sense to assess corporate governance from a disclosure standpoint only? And do you have any other recommendation regarding board practices that we should consider? I know that you are coming back right now today from a board retreat where you had a board evaluation and also a kind of training on CSRD. So I would like to hear from you, David.
Thanks. Well, we discussed in relation to the CSRD training and for the board aspects around materiality as well, around what goes in the disclosures versus what goes into the behaviors of the company and of the board members. I think I will start by a bit like David. David started with the OECD definitions of what governance is about. And here, there is one reminder that might be useful as well, is that the G of ESG is in a sense different from the G that you have in the corporate governance code. So the governance for the same name has different kind of meanings. If we take under the CSRD, the ESRS G1 that addresses governance is very much around business conduct and the aspects around that. If you take the traditional approach and continuing the definition of David, governance is about the board, how the board works, its roles, responsibilities, its composition, its structures, with the different committees, how risk management is overseen and governed, and the same way as how remuneration can align practices. And when we look at that type of governance, which is the one that underpins really the long-term success of companies, a number of failures occurred for the last, I've been working in governance since the late 90s, and I have to say these questions come again and again from, I don't know, from Parmalat to Wirecard or to Carillion in the UK. So regardless how good the codes can be, there was always a question of overseeing actually the governance practices. One that is pretty well placed in overseeing the governance practices were bank supervisors. I mean, a lot of codes have evolved and governance practices have evolved as a consequences of the banking failures in 2008 and 9, when actually big questions was where were the boards and what they were doing actually. And as a consequence of that, as a revision of the Basel pillars, you have the pillar 3 that has been extremely developed, which is the disclosure part. So asking banks to be way more transparent including on the way they govern their risks and the internal controls and other aspects behind that. Besides actually that transparency, the supervisors wanted to understand how governance is organized inside. So you have actually the ECB and the different central banks, depending on the relevance of the banks where they were following the joint supervisory team, and that were actually and controlling, auditing the banks under the Pillar 2 this time, which is the oversight, and how governance and controls are organized. I think that it's relevant for banks because they have a very specific function, but that's a very costly exercise, So you need to find other types of proxy in terms of governance. And these are the boards. To me, the first proper relay relates to the boards. Then that begs the questions about what the board does actually do and how you ensure that the board is doing the proper things. I mean, if we get to, for instance, take Carillion in the UK, that went bankrupt, 5 years ago now, the UK Parliamentary Inquiry found and mentioned that its chair at the time was an unquestioning optimist when his role was to have been to challenge. And the skeptical oversight and the challenge of the board is something that is a practice, is a behavior, and that you don't necessarily find that. Often it can be a club of indeed gentle optimists that are supporting and willing to see the business succeed without necessarily asking what's underlying the success of the business and how to ensure that. I think kind of France and the French market supervisor, AMF, in its last report on the governance practices has pointed the finger on an important aspect, which is the review of the boards and the effectiveness of these reviews on the practices. Pointed out the aspect of independence of these reviews, of how conflicts could be properly managed, and the scope of these reviews from the board as a whole, the committees, but as well the contribution of individual board members to the work, focusing as well of how the different board members do complement each other, and that is one aspect that I think there is room for improvement, definitely on getting that the board work properly, and helping them actually to reflect on how they can be better. The reporting on these aspects are very often weak and poor. And then besides the board evaluations, I think there are other governance practices related to the board that are important. Investors do focus on topics such as time dedication of the board members, and that's an important aspect. And today, being a board member requires time, and you have to be ready to dedicate the time and efforts to actually be diligent, informed sufficiently, and address the topics that they are. You need to think of a way more strategic way of approaching your board composition as well. And what we can see is that a number of our clients and other companies that we know are implementing succession planning for their boards and strategizing the proper refreshments over the coming years, the proper balance of the needs of skills and experience that they would benefit depending on the strategic cycle and the topics they will have to discuss. By the way, the CSRD is asking now, in terms of transparency, that companies disclose how actually the board composition fits with the material risks and opportunities of the firm. Which to me brings me to another aspect that I think banks, and if we would leave aside the Pillar 3 and the supervisor's role in overseeing the governance practices, there is one aspect that there is way more focus on the suitability of the board members, beyond the simple kind of fit and proper aspects of the directors, which is way more now how suitable they are in terms of addressing individually and collectively all the topics that they have to cover. So if you have a board that is better composed with a refreshment that is well considered, I think that can be a very good proxy for the outsiders to ensure that there is someone that is in charge of working with the management to the success of the company and holding management accountable while having a good understanding of the risks ahead and managing them.
Thank you, David. David, do you have a feeling that investors pay sufficient attention to board evaluation and are engaged sufficiently in that process?
Actually, interesting enough is that from kind of, I'm not on the engagement team of Sodali, but we've been engaging with hundreds and hundreds of investors almost on a daily basis across the globe. They do care. They do definitely care, and these are questions that have been asked way more in a one-on-one discussions. When they meet individually with often the chair of the NOMCO or the chair of the board, where they do discuss how the board is being considering in terms of its own composition, its own work, how the skills are being implemented, and how the board do work. And there are some examples where especially in context of exposed boards, how the reviews of an independent review of the board effectiveness could be done or has been done. Yeah.
And David, allow me a follow-up questions. Do you believe in the value of self-board evaluation?
As an internal tool, that can be very useful. Again, it depends what do you do with the outcome. I have boards, kind of, the self-evaluations are very, in the practices, do vary a lot. It can simply be the board spending 10 minutes to reflect as a topic during the year. It can be structured through a questionnaire, but again, the outcome of it can be simply discussed in the NOM committee, for instance, or actually having the board spending 15 minutes discussing the outcome of that. And when we do our board evaluations externally, we can see some boards give us 20 minutes to discuss overall, over 1 hour. So the practices, again, diverge quite a lot in that. So sometimes it can be helpful. It's not always.
Thank you, David. I would like to turn now again in a conversation mode. And Anne-Hélène, I'm sure you're aligned with what was said about audit committee composition. What are your thoughts on that, Anne-Hélène?
Well, I think, David is totally right. You know, the composition of the governance bodies is really something which is very important and decisive in the quality of the oversight. I also agree when he said that what's important is what is done in practice. You know, when you say monitor the effectiveness of internal control, etc., monitor the effectiveness, it's something which is very strong in terms of wording. So what do you have to show as a board, as an audit committee, to demonstrate that you effectively, you really monitored the effectiveness of internal control? Speaking about board assessment and obviously committee assessment, because usually those two works in parallel. This is something which came out with Sarbanes-Oxley. Before Sarbanes-Oxley, you would not discuss board assessment, and in the proper, in the proper framework of internal control, you have to discuss the monitoring component, and board assessment was part of an assessment of the performance of the board as a whole. And that's where you had internal self-assessment of the board at first. And very quickly, the New York Stock Exchange picked up on that to say, hey, guys, once every 3 years, at least, we'd like to have an external board assessment. So this has come, as a consequence of implementing internal control framework, robust internal control framework. This was something very, very interesting in the process. A final point that David touched upon very briefly is about culture. And I think that in terms of what boards should be doing and paying attention a lot more is culture within the company. Why? Because culture is the foundational layer of a robust internal control. You can have all the key controls or very detailed controls that you want in a company, if you do not have a robust and strong culture and ethical culture, obviously, culture of internal control, culture of risk, culture of ESG. You can have many different angles looking at culture. You will never have a robust internal control within a company. And board composition, is highly dependent on the proper culture within companies. How do they value the governance model? If they value governance as, a valid actor in the discussion with management, building upon a robust, constructive challenge, then they will look to have the right people in the board with the right set of skills, able to validly challenge and, again, constructively challenge and have a two-way dialogue of governance with management.
Thank you, Anne-Hélène. I have to say that it resonates a lot when we look at the Lafarge case. I don't know if you have heard about it, but they were meant to be best in class in terms of CSRD and ESG matters, but at the end of the day, they were not performing that well. But David, would you like to add anything at this stage? David Herbinet?
Yeah. Thank you, Beatrice. Yeah, maybe just two quick comments. The first one, I said earlier that I felt that the focus should be more on implementing what already exists, and I think that's particularly applicable to what David has just been talking about. So if you take audit committees, there is an obligation for public interest entities in the EU to have an audit committee. That is not implemented necessarily across the board, and there is no consequence for that. So what is incentive today for companies, other than culture, as David and Hélène have said it, very little. And I think that takes me to the question of who governs the governance. I think all of this is presented today as best practices or good practices, but what are the consequences of not implementing what is mandatory in the European Union today? It's not just around implementing an audit committee. It's also about in my space, how audit tenders are conducted. It's also how the requirements of Directive 2013 on the undertaking internal control and risk management assessment of effectiveness and so forth, how all of this is done. So I think there is a lot of leeway that is given to companies to comply or explain, but not many consequences for companies that do neither.
Exactly. David, taking advantage of having you as an auditor, how do you think auditors can positively impact corporate governance, particularly in terms of internal control and quality of key audit matters? Can you elaborate a little bit on that?
Yeah, with pleasure. I think for the vast majority of companies, things work actually well. There is good governance in place. Directors take their duty very seriously. There is high quality of corporate reporting, very good interaction with stakeholders. So I think we need to build on that. I think the question comes to how to deal with the others. I think there should be a focus on providing an environment where good practice is encouraged and bad practice is dealt with. And I think that last part is important. Today, bad practice is not really dealt with, other than through a number of mechanisms that I'm happy to talk about. And I think that what is really important is to have a lot of focus on some of the key moments when dealing with a challenging company, i.e., I would call it a company with really poor levels of corporate governance, when we're facing these moments. And I think the auditor has potentially a key role to play in that. I really don't think that auditors should be the police of corporate governance, absolutely not. But I think auditors have a contribution to make. So if we're looking at what auditors should be doing in relation to, for example, to looking at the effectiveness of internal controls. And I think there is a question that is often asked, which is, should there be specific assurance on the effectiveness of internal controls? I think my simple answer is no. Or at least if I qualify that simple answer, I would qualify it that it should not be, in my view, done in a mandatory way. The auditors already have a responsibility under the international standards on auditing to consider the effectiveness of internal controls with a view to obtaining sufficient and appropriate audit evidence, to assessing the risk of material misstatements in relation to giving an opinion on financial statements. And tomorrow that will also apply to sustainability reporting. So auditors already have to consider this. They have to test the effectiveness of internal controls when they decide to place reliance on them. So, that is already very central to a lot of the work that the auditors are doing. But again, it is done in a measured manner and in a proportionate manner, because the auditor will consider concept of materiality and will have some flexibility to reflect, again, different types of companies, different situations faced during an audit, and consider cost effectiveness as well in the scheme of things. So I think that framework is good, but it can probably be improved and be enhanced. And just wanted to put on the table maybe some ideas that I think may be worth considering further. One is around the concept of key audit matters. So today, auditors of PIEs, or public interest entities, have to report key audit matters, which are those matters that, in the view of the auditor, are the most significant in the audit. And there are disclosures in the audit report on key audit matters. And I think that when you look at key audit matters today, very few key audit matters actually talk about internal controls or talk about the effectiveness of internal controls. And perhaps that's a topic for further discussion. Again, I would definitely not mandate a standard key audit matter across all companies, because that would lead to boilerplate response. But I think that where there are real issues, again, when an auditor comes to one of these key moments in front of a company that is definitely not doing the right thing, I think that's a weapon that should perhaps be used more often. Similar to the key audit matters, we can see across Europe and across the world, actually, a development of audit quality indicators. And some of these audit quality indicators relate to individual engagements, so basically are company specific. And of course, there are indicators of performance on an audit that are intrinsically linked to the quality of an audited entity's internal control environment and the effectiveness of their internal controls. So again, perhaps through audit quality indicators, there is an avenue there that is worth exploring to drive greater quality in governance and therefore in corporate reporting. I also think it could be useful to look at not necessarily what are good practices at a country level, but look at good practices at a sector level. because again, some of the sectors have got different approaches to corporate governance in particular. And I think the financial services sector is particularly interesting. You know, some countries have got something that is, I mean, in some countries it's called the senior manager and certification regime, and that, you know, there is something similar to that in Ireland, for example, in Europe, but also beyond Europe in Hong Kong, in the UK, in Australia, in Singapore. And this is about, you know, defining very clear responsibilities to management in terms of what is expected of them in the context of stronger governance. So I think that is already in place in a number of countries in the financial services sector. And I think this is, you know, an interesting approach in a sector to improve governance. In a similar way, in the financial services sector, you have what is referred to as trilateral interactions, where you know, the auditor, the regulated firm, and the regulator will come together and have a dialogue about some of the more challenging and complex issues. And that can be behind closed doors, but that can lead to real improvements in governance. Maybe I'll take just a couple more minutes to add some more ideas, and just it's in the spirit of sharing ideas and opening the debate. Especially, I think, in the context of the first reports that will come with CSRD assurance, and you know, again, let's remember that it's limited assurance for the first few years at least. I think it is expected that there will be more qualified assurance reports in the market, and I think that's important. That's good. That's probably new. That's not something you see very often in relation to financial statements. And I think if the market can be more mature about this and seek to understand what these qualifications means, I think that will provide the auditors again in the future with more tools to basically communicate clearly about some of the challenges that they face. And maybe I'll just conclude with an interesting story as well about the auditing world. You know, for a very long time, audit firms were criticized for not complying or adhering to the highest standards of governance and controls, etc., that were forced onto the companies that they were auditing. And I think that, in my view, that has changed quite significantly recently with the implementation of ISQM1, which is a standard on quality for audit firms, which require audit firms to identify their key controls, to test the effectiveness of these key controls, so very similar to what Anne-Hélène was describing earlier. And I think auditors are now reporting on the effectiveness of these controls in their transparency report. So, you know, I think today audit firms are really, I think, leading the way in terms of reporting on effectiveness of internal controls to the market.
Thank you, David. Extremely useful, and thank you for sharing all those good ideas. And I'm sure that David and Hélène, you would like to react on that. And Hélène, I guess you have elements to say regarding qualified assurance and things like that. Please.
Yes, definitely. Thank you, Beatrice. Just a comment. If there is no audit committee, then the full board is in charge of implementing what the audit committee is supposed to be doing. And in France, true, we have transposed the sanction regime to the fullest extent as what was proposed by the directive. This is not true for most of the countries in the EU, and that is certainly something that the EU should look to harmonize. What should be the sanction regime on that? Also, another point regarding inadvantage of internal control framework is that improper oversight by the audit committee of the financial statement is a de facto material weakness. So that would be reported to investors, so publicly reported. So if in a system where you have effective assessment of the effectiveness of internal control by the external auditors, in a situation of ineffective oversight by the audit committee, that would be publicly reported to the investors. And I think that this is very rare, but this is of tremendous interest to investors. Now, moving to the key audit matters, my understanding of why you do not have key audit matters with respect to internal control in the EU, it's just because auditors, and I take your point, David, that auditors have in their auditing standards to look at internal control over financial reporting, but this is nowhere close to what you have to do under a Sarbanes-Oxley type of internal control documentation and testing. So external auditors don't have the means to have to develop a proper, thorough understanding of whether, as a whole, every year for all key controls, the structure is performing effectively. And I can tell you from all my discussions with other audit committee chairs on the US listed companies, whether US companies or European companies, when you are in the board, in the shoes of a director, on the US listed entity with management assessment of the effectiveness of internal control, and even more external auditors' assessment of that effectiveness, it's much, much more comfortable. And why? Because IFRS is now so complex. It's so refined and sophisticated. You have, a level of complexity in various transactions. You think cryptocurrencies, you think carbon credits, and so on, that you need to have experts. And with a robust system of internal control, those experts cannot be somebody external to the company. The company has to have a system whereby it will be responsible for producing per se, natively, its own reliable information. And this is internal control over financial reporting. So it means that absent a very systematic approach to internal control, and I mean key control, I mean materiality, risk-based approach, and this is true also for management assessment of internal control, you will never have the proper assurance that the system is working effectively. So having the assessment by management and doubling on that, I can tell you from management assessment, it's the first layer of comfort for board members. If you add up with another layer with external assurance on that, I can tell you, you feel much, much more comfortable. So for me, and I would also add that this is a big improvement to audit quality, because when the external auditors have such a documentation, a real, annual testing campaign put in place with all the deficiencies qualified by management, when the external auditors have that already implemented, they are much more efficient and much more focused in auditing, the highly risky audit areas, and don't spend so much time in lesser, lower risk areas. So where I agree with you totally is that we should probably not jump to a full, assessment system by external auditors, but rather proceed gradually with first an assessment by management, which would require a documentation by the companies of how the internal control over financial reporting is performing. And then a few years after, once everybody, and probably with threshold for companies, obviously, a few years later, once everything is stabilized to a certain extent, then move on with having an external audit, which we can, graduate with the limited assurance, then reasonable assurance, so that it's something becoming routine, embedded into how companies are operating. But well, you understand, I'm a huge defender of that, and I truly believe this help the external auditors as well a lot.
Thank you, Anne-Hélène. David Risser, any comments?
Much agree with what both Anne-Hélène and David mentioned. maybe I will take as well a different angle, because most of businesses fail or succeed can be because of failures on controls, true, but it's much often because the business model is not any longer relevant, and I think boards, audit committees, and that's often a discussion that occur in the banking side, where we're thinking of kind of, for the large companies, splitting the role of the audit and risk committee into two committees, is because the audit committee was looking at the controls and, in a sense, backward, while the risk committee was discussing risk appetite, link of the risk kind of profile and appetite with your strategy and with your business model, which is looking forward. And these two are very important aspects, and ensuring that the relevance of the business model stays is extremely important nowadays in a changing world with high risks, with a lot of innovation. And we do hope, responding to Draghi's report, that Europe will revive a lot the innovation aspect as well. But when we look at these aspects, the relevance over term of the business model is extremely important, and that comes from the board as a whole. I think that if we link with aspects around the CSRD, it's very much linked to your material topics, but how the material topics kind of impact your business model and your strategy is there, needs to be implemented, and for boards needs to be embedded with a broader perspective of the strategic performance.
Thank you. Very, very relevant. Thank you. Thank you very much, David. You might have all heard about the breaking news of last week. So basically, the Commission President, Ursula von der Leyen, announced an omnibus regulation in order to cut red tape in key EU Green Deal's laws, including the taxonomy regulation, the CSRD, and the CS3D. So both David and Anne-Hélène, how do you see that the changes that you are bringing on the table will align with this call to reduce reporting burdens and costs for companies?
I start?
Yes, Anne-Hélène, please.
Well, I think, well, obviously, it's we don't yet know exactly what will be announced. I understand from previous discussion that there will be a reduction in the number of data requirements. The point is that there is a misunderstanding with respect to what is materiality and well, speaking of materiality in general, it means that really you're focusing on the topics with a major impact. And, if you properly carry out the materiality analysis, then you can come down to a manageable number of material topics, which will reduce the burden. So it's not so much in terms of data requirement. Those data requirements in terms of history, we had initial ESRS, then they have been very much reduced to a more manageable set of data requirements. And now we're speaking about, lowering the number of data requirements, but except for very large groups or conglomerates, so with a lot of activities, and those groups have the means and the resources to do things properly. But for smaller, medium-sized companies, I understand the target is precisely reduce the red tape for those types of companies. You won't have so many major impact, major topics which will be on which you will have an impact on, or on which you will be impacted by climate change. So I'm not sure it's really well. you know, it's well, it's really welcome in the picture. At a moment where all companies, you know, are geared towards producing that type of reporting, where they need certainty in terms of what is the final target, it already complexifies something which was already complex. Companies were, you know, grasping, organizing around that. So it's fairly late in the process. So we'll see what comes out of it. But for me, it's really, it misses, you know, the point regarding the materiality assessment. And speaking again about internal control, because internal control will apply tomorrow, you know, to non-financial information. It's really internal control. It's large cybersecurity incident, large frauds, large undetected errors. All this can bring companies to an end, into severe difficulties, into governance crisis. So honestly, internal control, it's not a cherry on the cake. You know, it's not something that you do because it's nice and it's compliance. It's something that you do because otherwise, it's something like a large cybersecurity incident, a large fraud was occurring. Your, you know, very existence in the near future could be at stake. So that's why when we speak about materiality, it's really what's material to you surviving the next year and the year after, etc. It's not just you behaving properly or being, you know, a nice guy in the courtyard. It's I think we have a whole different understanding of what materiality is. And coming back to my introductory words, I think we need to have guidelines exactly, you know, to what we expect behind each of these words. What is materiality? What is monitor the effectiveness of internal control? What do we mean by these words, so that we have an homogeneity in how we interpret this across the EU?
Yeah, I totally agree with what Anne-Hélène has said. I mean, materiality is key, and a shared understanding of materiality, and a shared understanding with the with regulators and supervisors as well. Because today, you know, a lot of, you know, sometimes a lot of the drives towards being cautious first rather than being proportionate is because of reactions from supervisors and regulators. You know, for example, in my space as well, in audit, you know, there is an annual review by ESMA of the quality of disclosures of companies in Europe, and they identify disclosures which, you know, at a company level and in agreement with the auditors, were considered not to be material, but nonetheless argue that this is a weakness and the deficiency, and that should have been disclosed. So I think there needs to be some leeway on the definition of materiality, and not you know, lowest common denominator approach in most circumstances.
David, no reaction on your side?
I think it will be first that will be welcomed by companies, that effort. I think from the client standpoint, it doesn't kind of really hit the main purpose, because if you apply properly materiality, I mean, if
David.
If you have over 1,160 data points that you have kind of to consider potentially, companies, when they do apply materiality, in the end, they have 500 material points, sometimes less. And understanding that, I mean, in the discussions kind of with the board members we had on discussing CSRD trainings on over, we've seen some boards that have, and coming to the boards in their kind of double materiality assessment outcome, they have some of them 50 plus material topics. and kind of 3 companies I have in mind, and not the smallest, have actually 30 plus material topics. One which we were very recently had less than 20 topics, and actually the chair of the audit committee was extremely happy of the work done, because actually these started to be manageable topics that were then actionable for the company. So that's one. Second, these aspects only relate, I mean, if we come to our core topic, that relates to E and S dimensions, very much to this climate risk, first and foremost, others biodiversity. But in a sense, a business as such, Anne-Hélène mentioned many other types of risks. Today, businesses fail as well for reasons, or succeed for reasons that are besides, in a sense, the scope of the CSRD as such. So I think it's very good. Everything that will be more, in a sense, easier to understand for companies is welcome. I think companies discussing with our clients, they just want one thing, is able to pause on the framework, take the time to digest it, and make decisions. If we start making decision and commitments on aspects that are, for instance, in the taxonomy, meant to be supporting a sustainable economy or not, and then you start changing that in a few years, it's difficult for a company to navigate and allocate assets, because today, one of the main discussions in all of the boards is, how do I organize my asset allocation?
Yeah.
It's an important point. We should leave time to open the floor for questions, but unless I'm mistaken, I don't see any questions in the chat mode. Do we have any participants who would like to take the floor? Any reactions? No, maybe you were too good, and you have put a lot, many ideas already. So no reaction so far. So what we can do, if you agree, both David and Anne-Hélène, as we are coming to an end, I would really like to give each of you the opportunity for final remarks. What would be your key takeaways that you would like the audience to remember? And is there anything you would like to add before we close? We haven't touched upon the role of the authorities, the supervisory authorities. So maybe you want to have a say on that, or anything else that you would like to touch upon. Shall we start with you, David Herbinet?
Yeah, happy to. I think there's been a lot of content in the last hour and a bit. From my point of view, I would repeat what I said at the outset. We're dealing with the European Union is a complex environment, and I think we need to find ways to promote good practices. Learning from all walks of life, all countries, etc., but respecting the culture of the member states, focusing on proportionality, on scalability. Especially with the development of the capital markets union, if we will have more and more SMEs that are listed or meet the definition of a PIE. And I think whatever framework we promote or we encourage, needs to be cognizant of that, of the fact that at one end you'll have, an LVMH, one of the biggest companies in the world, and on the other hand, a 10 million turnover listed business that is trying to grow in 2 or 3 countries, and you need principles, but you cannot force these 2 very different organizations towards the sort of processes. So scalability is important. I think there is a lot in the current governance framework in the EU that needs more work in terms of focusing on the implementation of what is already there. So in the spirit of simplification, reducing the burden on companies, etc. I would strongly encourage that we don't add new things, but we focus on existing things and doing them better. And I think one of the key things that deserves more attention is the oversight. And your question, Beatrice, on supervisors, etc. I think it is very unclear today who is policing all of this environment. A lot of the stock market regulators are at a member state level. We'll have different approaches, different practices, and so forth. So I think there is a need for more alignment on the policing of what is already there.
Thank you, David. What about you, David Risser? Any further comments?
Well, I'll start with the supervisors. We have kind of worked or developed or updated corporate governance codes in Europe and beyond over the last 15 years. And hence kind of had the chance as well to work with market supervisors across a variety of European Union countries. Surprisingly, maybe not, but many of them are under-equipped and understaffed to properly exercise that supervision. So that's one, and there will be actually a cost benefit aspect and how many resources you can dedicate on that oversight. That's one. I would like to maybe point two aspects further. One relates to and Anne-Hélène mentioned that, and I did, but want to reiterate the culture in the boardroom. So we discussed culture in general, but I think culture in the boardroom and the ability to hear and accept and address weaknesses that have been identified at the management and at the organization level is as well a very important areas of success or failure for companies. And now going more on the supervisory aspect, I think that shareholders and the dialogue between companies and shareholders and the way shareholders exercise their stewardship, engage with companies, but engage with companies on aspects that are meaningful, on aspects that impact the way companies make revenues and profits, the way they distribute that, and have responsible approach to business is something that I think could be enhanced and should be encouraged and enhanced as well. Transparency, where that we give, is only a tool for others and market players who then do something with it, digest it, and then turn it back as an eco. And that would be my final words. But when developing these corporate governance codes, in many countries, we do engage with issuers. And a number of them actually say, well, we do provide information on our practices. We might be weak in explaining why we don't comply, but we have to say, we put that information out and we receive extremely low feedback on these disclosures. And in a sense, the echo back from the outside on the market about I produce all of that, but what's the point? Is an aspect where I'm pretty sure further improvements can be made.
Surely. And I would like to finish with you, Anne-Hélène.
Thank you, Beatrice. So coming back to the question, so I totally agree that scalability is something which is important, depending on the sizes of the company, but also their complexity. The complexity of the business. If you have a small fintech, it's a small entity, but with highly complex topics. So scalability should take into account the complexity of the business that the company is involved with. Regarding, we should not lose sight of the, of the EU ideal, which would point towards harmonization of practices. I totally understand the point regarding different cultures across the EU, but the purpose of the EU was to create a joint market with, a jointly defined base level of how everybody would operate. So I would very much be in favor of harmonization of practice with the target interpretation as to what should be the bare minimum that would be required by everybody. And then finally, with respect to ways to contain costs with respect to reporting, and I think this is very important currently because we have the financial reporting and tomorrow we'll have the ESG reporting. So we have to manage the cost of the ESG reporting as well. I would have 3 points. Get the right culture within the organization so that it is working collectively to a common end rather than put obstacle and thinking through the process as mere compliance in the bad sense of things, Then hire qualified people with a blend of technical and IT skills and train people. Why IT skills? Is that if you want to have an efficient reporting currently, you make use of robotic process automation, of different, automation techniques. This needs people with the right set of skills and the blend of technical IFRS, ESG topics and IT skills is really a must-have currently. And finally, relentlessly scrutinize the system for inefficiencies, which means a hard look at the IT, at the level of automation, at the level of data governance. We did not mention data governance, but if we want to leverage the opportunities of that ESG is providing, that the CSRD is requiring companies to identify, we need to have a much better data governance within companies and how people are working, so process analysis. All this can help tremendously reduce the cost in terms of, implementing and operating on a continuous mode any system of reporting.
Thank you, Anne-Hélène. So that brings us to the end of today's webinar. I can promise that at ecoDa and with the help of Forvis Mazars, we will definitely develop a summary note, because I would not like that all those good ideas disappear in the air. So we will have this paper and we will be sharing this paper with our audience. And I wouldn't like to finish and to end this webinar without thanking very warmly our speakers, Anne-Hélène and both Davis, and also our participants. We had a few participants today, and we really look forward to seeing you at our next webinars. Be aware that in our pipeline, we will have a webinar on the CSRD, and another one on the deforestation law. So I hope you will follow us and come back for those webinars. So I wish you a great evening, everyone, and let's stay in touch. Thank you very much.
Thank you.
Thank you all.
Thank you.
Good
Bye-bye.
evening.
Good evening.